Pure Financial Advisors, a registered investment advisor. This show does not intend to provide personalized investment advice through this broadcast and does not represent that the securities or services discussed are suitable for any investor. Investors are advised not to rely on any information contained in the broadcast in the process of making a full informed investment decision. This is Your Money, Your Wealth on Talk Radio 760 KFMB. Now, here's Joe Anderson and Big Al Clopine.
Hey, welcome back to the show. The show's called Your Money, Your Wealth, right here on AM 760 KFMB. My name's Joe Anderson. I'm a certified financial planner with Mr. Alan Clopine. He is a CPA. We work for a company called Pure Financial Advisors. Thanks so much for joining us. Hour 2 coming at you, talking about some IRA mistakes that people make. And I got 7 birthdays, Al, that can change your tax returns.
Really?
Age 19. What do you think that has to do with anything about your tax return?
Well, you're no longer a dependent for your parents unless you go to college full time. That's one thing.
Then, if you go to college full time, then what's that age?
23. By the time you hit 24, you're no longer dependent.
Yeah, at age 19, age 24, if you're a full-time student, the kiddie tax provision ends.
That goes away too, yeah.
The kiddie tax is designed to prohibit a child's unearned income, typically investments, to be taxed at their lower rate, presumably, instead of taxing at their parents' rate. For 2016, the first $1,050 unearned income is tax-free to the child. The next $1,050 is taxed at the child's rate, and any unearned income over $2,100 is taxed at the parent's rate.
Yes.
So you can't necessarily say, hey, I'm going to give this money to Junior.
And then he's going to make all that capital gain.
Yeah, and then have him pay the tax.
It'd be cheaper, yeah. That's what they used to do.
Right.
Kiddie tax came along in my professional lifetime, which is 30 plus years.
That was probably a pretty good strategy.
It was a great strategy.
Hey, you got kids? Yeah, all right. So you got about, let's see, $30-some-odd thousand of capital gains.
Yeah.
Why don't we give it to the kid?
Yeah.
He pays the tax.
Yeah.
Right?
Family,
and then it'll be tax-free, and then he gives it back to you.
Yeah. Right.
And the kid doesn't even know it's in his name and then not in his name.
Yeah, right. And mom and dad can each, at that time, they could give the kid $10,000. That was the gift tax limit. So they could each do 10. So it was 20 grand of securities going to the kid. Kid sells it, pays no tax, goes back to the parents. Yeah. Pretty
Boom.
good. Yeah.
Oh, is that your broker calling you?
Yeah, it's my phone. Well, broker's not available. Oh, it's an accountant.
Oh.
Probably has a question.
Age 50. What does age 50 have to do with your tax return?
50. Well, then you can put more in your 401k and your IRA.
Yep, it's the catch-up contribution. So age 50, 50. This terminology is a bit confusing since there is no requirement to be behind in your plan contributions in order to be eligible to make up the additional elective deferral. So 2016 limits allows 401k, 403bs, and 457 plans. So that's unchanged. So it's $6,000 catch-up. Simple IRAs and simple 401k accounts, $3,000 catch-up.
Yes.
And then the Roth IRAs and traditional IRAs is $1,000
Catch-up.
catch-up. The contribution limits are, of course, $5,500 for IRAs, and then $18,000 for the standard contribution.
Yeah. What's the simple?
$13,000.
Yeah, give or take.
13,000.
I'm not sure.
The simple plans, I don't.
Well,
I very rarely recommend a client to go into a simple plan because of the new 401k plans. Or, but I mean, if they have employees,
yeah,
and they don't want to contribute to the employees
we,
as much.
We actually just spent our tax class. We do an internal tax class for our advisors on Thursday, and we went over the simple IRA in ad nauseum detail. That was my associate putting that together. So I actually cut it off about 20 minutes early so we could get into, all right, so now we know everything we could possibly know about the simple. But what's the right kind of retirement plans do you actually use? And we had a very, very good discussion, and I digress a second, but if you're self-employed and you don't have any employees, the vehicle of choice is a solo 401k or individual 401k. The simple, you would never use a simple if you don't have any employees. The 401k is so much better, right?
Because you can put more money into it.
Right. Yeah, and if you need a giant tax deduction and you're going to be making money for a while, then look at a defined benefit plan. Those are a lot more expensive and complicated, but you can actually put away, as a couple $100,000, depending upon how old you are, actual tax deduction. But both of those plans have to be set up by the fiscal year. So if we're talking about 2015, you can't do either one because it's already into 16. But you still can do a SEP IRA all the way to the due date of your return. So that is still available.
What about age 55?
55, that's the age when you retire and have a 401k. You can pull that money out tax-free. Not tax-free, without penalty.
Yeah, qualified retirement account prior to age 59 and a half are subject to 10% penalty to additional to ordinary income. However, this penalty is waived if you are at least age 55, age 50 for state public safety employees. In the year you retire, quit, or fired from your employer. Since this waiver only applies to your company retirement plan and not IRAs, you should wait until you're 59 and a half. So I had this instance with the 403B plan. And so the law states it's a qualified plan through your employer, right? Trying to get the right person on the phone to let them know what the rules are is almost impossible.
Right.
They were like, well, no, how old is the client? 58. He's retiring. Well, no, sir, you have to wait till 59 and a half. No, you don't. Well, yes, 59 and a half. He's separating from service. So he is over age 55.
Yes.
We would like to start taking distributions from his retirement account. Well,
never heard that.
Let me talk to someone. Okay, can I please talk to your supervisor? Talk to the supervisor.
Same.
And it's just like, okay, then I go, I'm going to have to hang up on you and call again and try to find someone else that knows what the heck the law is. Finally, after 4 or 5 calls, you get a hold of the right person. Yeah, no problem. Okay, well, I see you separated from service last Friday. No problem. It's going to take us about a week to make the distribution. Right? And it's like, well, who's training the employees? But that's the problem, I think, with individuals when they're like, all right, they'll hear something from our radio show, right? Oh, hey, you know what? I want to retire a little bit early. Or I separated from service at 55. I'm 58 or turning 59, but I'm not 59 and a half yet, so I can't touch this money. No, you can. So they'll call and they'll say, hey, can I take a distribution? And the person on the other line of the phone will probably say no. And then they'll think, oh, Joe and Al, they don't know what the hell they're talking about.
Clearly, they're foolish.
This is, oh, yes. So
your next one's going to be 59 and a half. I can feel it.
No. Well, no? I guess if we want to go in order, 59 and a half. Okay, how about 62 then?
62, that's the year where you can take Social Security.
Okay. 25% permanent reduction, though, if you take your Social Security early. Age 70 is Social Security deferral ends. So your 8% retirement credit, that's it.
So real easy example. If you were supposed to get $1,000 a month at age 66, that's your full retirement age, it'll be about $750 a month if you take it at 62, but it will be about $1,320 per month if you wait till 70.
And then age 70 and a half, of course.
That's our required minimum distribution. And now you got to take money out of your IRAs and 401ks, even if you don't want to.
You have to take a look at publication 590B. All right, we got to take another break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner. Big Al Clopine, he's a CPA. Go to purefinancial.com. Open 24 hours a day.
That's for you, Megan.
Oh, man. We're talking retirement plans, retirement planning mistakes, taxes, the markets. Two-month high. Is that the...
I just, it's Dow was closed at a 2-month high on Friday.
2-month high?
Yeah.
That's
after the jobs report.
What, 224,000?
Huh?
224,000 jobs?
I think it was 243, if I'm not mistaken.
Oh, I'm dyslexic. I'm missing a
Give or
couple
take.
digits. 200 plus?
Yeah. I do remember for sure the estimate was 190. So it exceeded expectations, and the market liked that.
Yes.
And we talk about this all the time. When does the market go up? When things happen better than everyone's expecting.
But here's the problem with that number, Al.
What?
Is the Fed, right? Coming out in a couple weeks. So are they going to raise interest rates?
That is a problem, yeah.
And so it's like, okay, well, now that the economy, unemployment's at 4 something, you know.
You know what I read there, though, Joe, which was this. The wages have not gone up. In
Right.
fact, they actually went down a little bit. And that's probably one of the number one indications of inflation. And so, yeah, there's not a huge, at least in my humble opinion, there's not a huge reason to raise the rates yet. We'll see. We'll see what they think.
Yeah, well, stay tuned.
Yeah.
I'm just biting my nails.
I can't even sleep at night.
I know that quarter point. It's going to kill us. 10-year Treasury is at, what, 1.6? I think it's all right if we hike it up a little bit. I'm not an economist, so don't listen to me. But if
and I'm not either. We have an economist on this show from time to time, Chris Thornburg, and we look like idiots just asking him questions, let alone trying to respond to his answer.
I know. It's like I get so nervous. He's going to make me look like a complete idiot. I've been doing this close to 20 years. I think I know a lot about a few things.
I do remember one of them that happened with me. I asked him about, I said, well, the deficit is $17 trillion. He goes, Al, the deficit is our current year budget shortfall. Our national debt is, sorry.
Yeah, never mind. Never mind. So, how about those Padres coming up here?
That's always a good go-to. In fact, that one of my good friends, that's what he always does. I mean, probably if I'm with him an hour, I hear that about 5 times when there's some uncomfortable thing. How about the Padres?
Hey, what do you think they're going to do this year? Hey, I want to talk real briefly a couple of other mistakes that you're making when it comes to IRA contributions. Is there's also something that's called a spousal IRA for non-working spouses. So let's say that you're working, your spouse is not working, or your spouse is working and you are not working. Both spouses can still contribute to a retirement account. Only one spouse needs earned income for both spouses to contribute to the retirement account. So a non-working spouse can still contribute. We see this mistake often. When you're looking at, hey, I have some money in brokerage accounts or cash, where the whole time they could have been contributing that money into a Roth IRA to have all future growth grow tax-free. You're just positioning from cash into a Roth IRA, right? If you need the money, you can still pull the money out, but now it's in the shell of a Roth. I mean, so non-working spouses can still contribute to a retirement account. Here's the deal. You can have a 401k plan, right? And you're contributing to an IRA. Your spouse can still contribute to an IRA or Roth IRA.
Yeah, that's a big deal, Joe. And I think it's often missed. I mean, when we talk to people, they'll have, they have a couple $300,000 outside of retirement, perhaps. And they've got nothing in a Roth IRA, and then you look at the income, and if they're married, if it's the 2015 limits, if their income is below 191,000, they can do a full Roth IRA contribution. Both spouses, the spouse that's working and the spouse that's not working, they can both use that same earned income. And if they're over 50, they can put $6,500 in. If they're under 50, it's $5,500. So wouldn't you rather take some of that $200,000-$300,000 that's sitting outside of retirement and put that into a Roth IRA, because all of that future growth in income is tax-free? And then some people say, well, no, I don't want to do that because I can't touch the money for years. I got to wait 5 years to touch the money. And you're mistaken. When you do a Roth contribution, you can pull that contribution out the next day if you want to. I don't care what age you are. There's no penalty. Now, you do have to wait 5 years or over 59 and a half for the, no, I don't want to go there because I've already screwed that up. You have to wait 5 years to pull out the income, right? And that 5-year clock, interestingly enough, starts at the first time you do a Roth IRA with regards to contributions.
Conversions is a totally different story.
It is, and that's where people get so confused because they think they're the same thing.
Right.
And my accountant said, I can't do a contribution. My income's too high. And we're saying, the word out of our mouth was, you can do a conversion. No, I can't. I can't do a conversion because my income's too high. They're thinking contribution. Conversion, there's no income limit. Conversion is taking money out of your IRA, 401k, and converting it to a Roth IRA.
Everyone that's listening to our show right now that has a retirement account can do a conversion.
Yeah, everyone. age 20, age 95. You
and
can
there's
do
no
a
10%
conversion.
penalty to do the conversion.
No penalty at any age, and you can be retired, you can be working, you can whatever, right? You can do any income level. I'm sorry, you can have any income level, and you can do any amount. There's no limits on how much you do.
So individual comes in, very high net worth individual. I think his net worth was close to $20 million. $2 million in a retirement account, and so he's looking for some tax planning ideas, right? And he's got a lot of money outside of retirement, of course, if he only has $2 million in his retirement account, a ton of real estate, and he's making $300,000-$400,000 a year. And he's single, and then he found out that he is terminal, right? And he really wants to make sure that he gets this money to his kids and his grandkids, right? And so he's like, well, what should I do? Should I set up a trust, or should I do this and that? I mean, there's all sorts of different estate planning ideas that we have for him. But one of the biggest impacts that he can, because he really wants to make sure that his grandkids are going to be taken care of. And I think his grandkids, he had two. One was 3 and one was 5, right? He's got over $2 million, 2.3 million bucks in his retirement account. I said, well, here, this is a first strategy, convert the 2.3 million bucks. And he's like, well, I can't do a Roth. I go, yes, you can. You can do a Roth. Well, no, I'll make way too much money. No, take the 2.3, convert it. Well, I'm going to have to pay a bunch of tax. I go, well, here's the problem. You're either going to have to pay tax, ordinary income tax, or you're going to have to pay estate tax on it, because you're way over the 5.5 roughly $1 million exemption. So then we have to pick our battles here. And you're telling me that you want to make sure that you can parlay some significant wealth to the grandkids. I go, the Roth IRA is probably the best gift that you can give to a young individual. And so you explain it to them like this, is saying, all right, now you convert it. Yeah, you're going to have to pay some tax on that. But so you take some money out of your non-qualified accounts. The estate tax, I mean, remember when it was 55%, Al?
Yes, I do. And it was a $600,000 limitation, meaning that when you passed away, anything over $600,000 you had to actually pay tax on. Now it's $5,460,000 is the limit, and it's what, a 40% tax.
So convert that, pay, right? You pay some ordinary income tax on it, but then the kids will inherit $2 million, give $1 million a piece to a grandchild that's 5 years old or 3 years old. They can have all of that money, still continue to grow tax-free for their life. I mean, you're talking millions of additional wealth there.
Well, you are talking millions, and really when you think about it, then all of a sudden when you pay that tax, your estate's lower and you pay less in estate taxes. So you end up doing a lot better for your kids and grandkids, and it's all about taking control over your taxes, because you really have more control over taxes than you think. In fact, you have more control over paying taxes in retirement than any other time in your life. And when you are retired and thinking about transferring assets to the kids, boy, there's some really good, solid moves that you can do. You just have to know what they are and execute. But your stockbroker, your financial advisor, or even your CPA don't understand how to lower your taxes in retirement, because it's, let's face it, it's not really their expertise. The only way to lower your taxes is by having a forward-looking, tax-efficient strategy.
All right, we got to take a break. We'll be right back. Show's called Your Money, Your Wealth, right here on AM 760 KFMB.
Now back to Your Money, Your Wealth on Talk Radio 760 KFMB.
Hey, welcome back to the program. Show's called Your Money, Your Wealth. My name's Joe Anderson. I'm a certified financial planner with Alan Clopine. He's a CPA. Thanks for tuning in. Go to purefinancial.com. There's a lot of great information there on our website. We're one of the largest fee-only financial planning firms here in Southern California. We do not sell any products. There's never a commission generated to our firm. We act as a fiduciary 100% of the time. I was listening to this radio program, and so he was talking about the fiduciary standard.
Okay.
Right? And he's like, well, only there's 80 some odd percent of all advisors are still on the suitability standard, right? And, maybe 15%, are true fiduciaries.
Right. Okay.
Right? And he goes, well, my firm is a true fiduciary because, you want to work with a true fiduciary that can, give you advice, and then also look at, have a variety of different products that you can, purchase from when it comes to like life insurance, to annuities, to
real estate investment trust.
And I'm like, well, wait a minute, man. That's all commission. product.
That's not fiduciary.
The kids, is that really a fiduciary? I don't know. Well, maybe you have a different definition than I do. Because that could create a conflict, couldn't it? If I'm selling you a product that I generate a commission on, wouldn't that maybe cause a conflict of interest?
Isn't that why the Department of Labor is spending all this time to change the rules?
But maybe in his mind, the fiduciary is, well, no,
I'm a fiduciary in my own mind.
in my own mind,
Yeah.
because I could sell you thousands of products and make millions of commissions.
Yeah. And I'd only do what's in your best interest.
Well, I would never sell you this life insurance contract. I mean, this is what killed me. Same individual that I hear. Then an advisor comes in my office and says, Joe, I got a case here, and I really don't know what the heck this guy's doing. And neither does he. And he's got this advisor that's given him this advice, and what is your take on it? So, Al, you'll appreciate this.
Okay.
So there was an individual that had money in a retirement account. He's under 59 and a half. Okay. And the advice from the advisor, and I think it was like close to $600,000. The advice from his advisor, quote unquote fiduciary advisor, was this: take money out of your retirement account to fund a life insurance contract. He's single. No
Really?
heirs.
You're kidding me.
No.
Under 59 and a half. So he pays taxes and penalties.
And penalties.
And then he gets in this very expensive product.
And so he's already put 3 years of contributions in.
Oh, boy.
The cash value of the life insurance contract, so what, 3 times 12? You can do the math, right?
Yep.
36?
Yep.
$36,000 he's put into this life insurance contract. The cash value is $5,000
$5,000.
because of all the cost and everything else. And plus $36,000, 25% tax bracket, 10% penalty, plus state tax.
Right. So it really cost him about, I'm going to say $60,000.
$60,000
To pull this money out.
to pull the money out.
This $32,000, now it's worth $5,000.
Now it's worth $5,000,
So
but
$60,000 to $5,000.
but it's going to grow 100% tax free for him.
Yeah, and well, I can tell you what that advisor would say. Well, Joe, but once we get through the surrender period,
Right, or
yeah,
it's
great.
got time to grow. The guy's like 59 or he's 55 years old, 54 years old, or something like that.
Right.
And it's like, whoa, no. I understand tax free. I love tax free, right? But this is how you do it, right? Stop this now, right? Because you're gonna have to live until 80 to you see the illustrations too.
Yes.
Where you're gonna pull all this money out tax free.
What are they running the illustrations at now? Like 8%?
Well, who knows? Depends if it's a variable contract. I don't think they can go anything higher than. I remember I've seen contracts where they would up to 12%.
Yeah,
I think they probably tone it down.
I've seen 10. You've seen 12?
Oh yeah, back in the day, sure. 10 years
Okay.
ago, 12% for sure.
Yeah. Okay.
But then you look at then you have to look at the guarantee, and they use the tax code, right? They're like, well, no, you can use this, IUL or variable universal life policy because the IRS does not tax it because it's FIFO tax treatment. Then you're going to take loans from yourself, and you have this tax time bomb in your retirement account. You need to bleed that out and put it in this life insurance contract. Okay, yeah, I understand you want to bleed out the overall retirement account, depending on what your tax bracket is now, what it's going to be in the future. But why don't you do Roth conversions? Why don't you get the money into a Roth IRA, pay a little bit of tax? There's no 10% penalty if you do a conversion. And guess what? You can go into low-cost funds and there's no cost of insurance. And then that money's going to grow 100% tax-free. If you don't need the insurance, it's like, but there's pretty good salespeople out there.
Yeah.
So,
yeah.
I don't know.
Well, Joe, that reminds me. This was probably a year ago. We had a client email us and said, I think, what about this? And I'm going to get the letters and numbers wrong, but what about the 704B6 plan?
Yeah, right.
I go, who knows what that is? So you Google it. Sure enough,
it's life insurance.
It was a term invented by this financial planning firm, a number of sequence that they made it sound like a code section, and it's a firm in Florida selling this stuff. And then you read their stuff and tax free this, tax free, and if you kind of know what's going on, you know that it's a very expensive life insurance product. And so, it was very well written, and it had some famous person saying, "Oh, this is the best thing," and the banks don't want you to know about this, and the government doesn't want you to know about it. It's like, oh my goodness, you spent a lot of time and effort coming up with something. It's all smoke and mirrors. It's just crazy.
if you haven't started planning for retirement, you're not alone.
That was a good segue.
This is the 5-year retirement countdown, Al. Just 29% of people said they have a written retirement plan, according to a survey of 1,000 people with household income of $50,000 to $100,000 conducted by Wells Fargo.
29%. Okay.
31% of workers are worried their money will run out as early as 15 years into retirement. This is according to a 2015 survey about 5,000 U.S. workers by Willis Towers in Watson. 31% of retirees said they had no specific expectations about retirement spending. That's another survey of 1,200 adults by a financial services firm, PNC. So it's time to start looking ahead, folks. I know you listening have probably saved some money. You probably have some sort of game plan in your mind. A lot of people haven't saved a lot of money for retirement. So what's that going to do is going to put a strain on the system. In Al and I's opinion, we believe that tax rates probably will go up. So now, more than ever, I think you want to protect your life savings and figure out, from a true CPA, taxes, there's significant tax strategies that you can do to keep more for yourself and not the IRS. Because if you could just imagine your retirement game plan that was just no longer about a number, that you you spoke to your wife and your husband, and you got to start having a conversation about money is the first thing. A lot of times people don't want to talk about it because it might cause a fight, it might cause this, it might cause that. And I get it. You don't want to talk about politics, money, sex, and whatever. I don't know. There's probably a couple more that, people, it's
Religion.
taboo. Religion. Yeah, there you go. All right, we got to take another break. Show's called Your Money, Your Wealth.
This is Your Money, Your Wealth on Talk Radio 760 KFMB.
Show's called Your Money, Your Wealth right here on AM 760 KFMB. My name's Joe Anderson. I'm a certified financial planner with Big Al Clopine. He's a CPA. Thanks for tuning in. If you want more information about our firm, go to purefinancial.com, purefinancial.com. A couple of things there. I recently did a Social Security webinar. There's some changes that are happening with the Social Security for claiming strategies. So if you want to learn all about that, you can go to purefinancial.com and click on the webinar. It's about, maybe an hour, less than an hour. You can watch it at your leisure, right there in your pajamas, right there at home.
Yeah.
Don't have to go anywhere. And we're doing a lot more of those. So go to that website from time to time because we have a lot of new things that are coming down. I think I'm doing a webinar on Medicare coming up. We're also doing a last-minute tax planning webinar.
Yeah, that one's early April, I think.
Yeah, that's coming up in the next few weeks.
Yeah.
So right in the beginning of April. We're also doing some identity theft stuff. We got so a lot of really cool things that we're trying to get out to you in a form of like WebExes, webinars, and just more information and education for you. So go to purefinancial.com, stay in the loop there, get on our newsletter, and then that will keep you informed of all the different events. And we do a ton of live events as well. Al and I speak all over Southern California. So go to Pure Financial, get on our newsletter list if you want to keep informed of some cool things that are coming down the pike for 2016.
Yeah, absolutely. And boy, speaking of identity theft, the IRS has come out recently. This is IRS Commissioner John Koskinen. He says
Koskinen.
Yes, Koskinen.
You know what that movie's from? John Koskinen.
No.
Fletch.
Fletch. Okay.
You've never seen that movie, have you?
No.
You've never seen Fletch?
No. Is that Will Smith?
What? No. Chevy Chase.
Oh, that one. I was thinking. What am I thinking?
Hitch?
Maybe. Yeah. No. I've seen Chevy Chase. Yeah, Fletch.
Fletch?
Yeah, that was a long time ago.
Fletch Lives?
Yeah, I don't remember the names of characters like you do. Wow, you got quite a memory.
Steel Trap. Well, that's a very good movie.
Anyway, so you know what, Joe? Some of these IRS, some of these schemes, like there's one that's increased 400% just this year already. So here's a couple things to be aware of. One is phone scams. Some fraudsters they make aggressive phone calls in which they impersonate IRS agents, threatening police arrest, court action, deportation, license revocation, among other things. They try to trick taxpayers. And there's been roughly 900,000 taxpayers contacted, more than 5,000 victims who have paid over $26.5 million to these people.
Wow.
So watch out. And the IRS says, you know what? We don't call you. We'll send you a letter. So if you get a phone call, it's not the IRS. And here's a little caveat. If you think you owe, well, then hang up and call the IRS so you know you're actually talking to the IRS, not somebody impersonating. So that's a big one. Another one is identity theft. And boy, this is getting to be a really big deal because some of these thieves are breaking into like Target and other companies, getting sensitive data, Social Security numbers, and then these fraudsters are filing fake returns and getting tax refunds. And right now, there's like 776 identity theft related investigations going on. 2,000 identity thieves have been convicted in the past 3 years. So that one is tough. That one's really tough because you don't have control over that. I think one thing that is recommended there is to file sooner rather than later, so you beat these guys to the punch. So a final one I'll bring up, Joe, is it's called phishing. Not the kind of fishing that you go to the lake and throw your line in. It's phishing, and this is where criminals create fake websites looking to steal personal information, right? And so what they do is they send you an email. They're trying to get some information out of you and send you to a website that looks like it's the IRS, and you put in personal information, and then they go ahead and do all kinds of stuff with it, including filing fraudulent tax returns. So those are three big ones to watch out for.
How about if you don't have a refund? Then what happens?
If you don't have a refund?
Yeah, because they're filing and trying to get their refund. Is what they're doing.
Well, probably in some cases they
just take that information and.
Yeah. So like let's say it's pretty clear there's no refund and they file the wrong information, and then the IRS doesn't. They're not going to send the refund because it doesn't agree with their records, right? But in some cases it's like.
Or they're just making up all the numbers, and the IRS is not even. I still don't understand how they're doing it.
Well. It's difficult when you are a wage earner because they can match the wages, and if it doesn't match up, they might kick it out.
But do they do that with every return?
Well,
or they probably there's no way they probably could.
Yeah, I'm not. I really don't know.
You know what I mean?
But one thing I do know is some things aren't really traceable. Like for example, what if you're self-employed and you made estimated payments? So this fraudulent return goes in. The IRS has no way to check it, right? So they just send a refund out. So yeah, this is getting to be a big problem. I had this happen with a client of mine a year ago, and it took something like 8 or 9 months to get this straightened out to where a refund actually was issued, a correct refund was issued. But anyway, yeah, it's getting to be a big problem, and it's you can understand why people are very guarded with their Social Security numbers. They really should be, because there's a lot of things that can go wrong.
Well, that was a way to end the show on a happy note.
I'm just saying, be cautious.
Yeah,
be cautious. Be cautious. Yeah, that's because when it comes to taxes, I mean, first of all, we all feel like we're paying way too much as it is, and then it's like, now do we have all these other things on top of it? Now we have fraudulent people saying they're the IRS, and we get so freaked out we send them money, or people are filing fake returns, or we're succumbing to some of these emails look very real. So it's just all about being cautious so that you're not really paying any more tax than you need to pay, and you're not losing any more money, right, that you need to lose. And I think it's at least for me, I guess I'll kind of end it this way, because it's hard sometimes. I mean, it's good to be aware of these things, and so you try not to fall prey to them. But more importantly is, what really can I do, right? One is to be careful when you get suspicious emails or phone calls. But another one is, I have some control over the taxes I pay by looking at the strategies that are available to me. And when you're in retirement or close to retirement, you have more control over how much you pay in taxes than any other time in your life.
Show's called Your Money, Your Wealth. Have a wonderful weekend. We'll see you again next week.